Hi everyone, welcome to the Real Estate Tax Tips channel. My name is Cherry Chen, a chartered professional accountant located in Oakville, Ontario, Canada, just outside of Toronto. And I'm on a mission to become the Google Map for hardworking Canadians seeking financial freedom. And today's topic is the year-end tax tips for everyday Canadian. And I have 10-ish tax tips for everyone here. But before I get started, make sure that you hit the subscribe button below and give us a thumbs up if you want to stay on top of the latest tax tip. Now with that, let's get started. Well, there are about 10-ish year-end planning tax tips. The first one is RRSP contribution / RRSP withdrawal. You may say, well, Cherry, you have until 2 months until after the year end to contribute to RRSP. Why do you have to plan this right now? Well, it is important to gather all your information and look at your income as a whole and see if you have any savings set aside to contribute to RRSP. The reason why it is important to look at RRSP contribution right now is because some Canadians have employer matching RRSP program. So this is a time to contribute depending on the plan and how it's being set up. Sometimes you are required to contribute within the same fiscal year so that they would match it. Sometimes it is beyond the year, 60 days after the year end. Now, another important tip here with RRSP is that for those of you who have incurred a substantial amount of losses in the last year or have very little income, you may want to consider withdrawing some RRSP in the current year. It may be, you may be able to offset some of the taxes that you would normally trigger when you withdraw RRSP, because when you withdraw RRSP become an income on your personal tax return. If you have no other income or if you have other business losses incurred, you may be able to qualify to offset some of the losses with your RRSP contribution, and hence you will not need to pay as much tax or pay zero tax on the RRSP withdrawal. So the second tip is withdraw your TFSA if you are planning to do some withdrawal in the near future. Well, the way the TFSA contribution limit works is that if you withdraw TFSA in the same year, the TFSA account would give you the credit back. The amount of withdrawal will be added back to your TFSA contribution, but not within the same year. It's only added back in the following year. So if you're planning to withdraw TFSA in the next few months, you may want to consider withdrawing before year end so then it can be added back to your contribution for 2023. Okay, number 3 is tax loss harvesting. If you made a lot of money in 2022, I doubt it, but for some people, there are a lot of people out there that may have made a lot of money. It may be worthwhile thinking about doing something called tax loss harvesting. What it does is that if you haven't made a lot of capital gain or if you've made a lot of investment income, and you look at your portfolio of real estate or stocks and you identify the ones that you could easily liquidate and it has accumulated losses accrue on that particular stock investment, you could then turn around and sell it. And by selling that particular stock that you have accrued losses on, you're now realizing the capital loss on that particular stock. And you could use the capital loss that you otherwise would have anyway. It's just not unrealized and you cannot report it on your tax return. You can now realize the loss and apply the capital loss against the capital gain that you've incurred during the year to offset against each other and therefore lower your taxes. Now, if you're still bullish on that particular stock or that particular investment, you could turn around to buy that particular stock back. However, you could only buy the same stock after 30 days. Otherwise, the CRA is going to consider that realized capital loss as superficial loss, and if it's deemed to be superficial loss, you're not allowed to apply that capital loss against your capital gain. So it's important to make sure that you do that before the end of the year and do not repurchase the same stock within 30 days. Now, for those stock investors out there, you might be very sophisticated and you understand stock options altogether, and it may be worthwhile considering buying stock options of that particular stock instead if you are really bullish on the stock. Okay, the fourth one is to make sure that you pay your spouse and pay your kids. If they did anything for you, for your business, for your rental property portfolio, it's important to make sure that they send you an invoice and you pay them with a reasonable amount of salary or wages or subcontractor fees. The reason why it is being done, it has to be done this way, is because you are truly paying for their services. If you were to hire someone to mow your lawn, if you were to hire someone to do the bookkeeping, if you were to hire someone to do the administrative tasks in your business, you would still have to pay them. And you pay them on time. You don't pay them after year end or not pay them at all. So you still need substance to the transaction. And so make sure that you do so before the year end to substantiate the work and also the deduction as well. Now, the fifth one is to pay yourself. So if you have not talked to your accountant about strategies to dividend versus salary, or if you haven't talked to your accountant about tax planning, it's important at this stage to really talk to your accountant about how to minimize your taxes from your business by paying yourself a dividend or salary. It's also important to take advantage of your low marginal personal tax rate to take advantage of that, because everyone in Canada every single year is entitled to that low marginal tax rate. Make sure that you maximize the use of the low personal marginal tax rate to minimize the personal taxes that you would have to pay by paying yourself before the end of the year. Okay, the sixth one is to buy a car. I know this is a crazy one. There's only so many days left in the year. If it is possible for you, and if you are planning to buy a car anyway, you may want to buy a car before the year end. The amount of deduction you would get is the same whether you buy the car at the beginning of the year or at the end of the year. If you're planning to buy a car in the near future, you may as well just buy it a little bit earlier to help you to lower your tax deduction, to lower the tax amount that you would have to pay. For those investors, real estate investors, as well as business owners out there, this will be helpful, especially for those of you who use your car for employment purpose, for business purpose, for managing your rental portfolio purpose. The seventh one is to spend on major appliances for real estate investors out there, or even for business owners out there. Spend on capital expenditure if you would be able to squeeze it in the next little while. The reason is the same as buying a car. If you are planning to replace the roof of your rental properties, if you're planning to buy appliances anyway, you may as well just buy it in the current year. The reason is that if you buy it in the current year before the end of the year, you're getting the same amount of deduction as if you were to buy it at the beginning of the year, except the cash flow is already out the door and it gives you tax deduction and tax write-off in the current year rather than in the next year. And the amount of deduction is the same whether you buy it in current year or next year. You may as well get the tax benefit anyway. For those of you who are thinking of replacing the roof or replacing appliances or doing some work in their offices, improving their business or buying some capital equipment, you may truly want to consider spending it in the current fiscal year to maximize your deduction and lower your taxes. Okay, the number 8 is for those Canadians out there who have their own businesses or have side hustles. If you have been operating as a sole proprietor for the last few years, and if you are making good money, you may want to consider having a corporation set up to delay some of the taxes that you would otherwise have to pay. In Ontario alone, in the corporation, you only need to pay 12.2% tax, versus if you earn income in personal name, and the taxes can go as high as 53.5%. So there is a significant tax deferral delta if you operate your business within the corporation setting. So this is the time to consider operating your next year's business all inside the corporation. And that's something for people who have side hustle or who are sole proprietor, who has been operating as a self-employed individual, should consider at the year end. Now, the number 10 one is specifically for real estate investor. I don't know if you guys are aware, there is this vacant home tax that's being implemented by the local government. For example, City of Toronto just sent out a massive mailing yellow letter to every homeowners in City of Toronto. My mom got it. My mom still has a house in Toronto, and I have to report on behalf of her that the house has been rented. Myself, my own townhouse in Toronto also got a letter, and I have to go on their website to report it, and you have until you have to until 2023 to report it, but don't forget to report it. Now, for those real estate investors out there who own their rental properties in the corporations, and now it also matters for investors who own their rental property, residential rental properties in a corporation, there is a federal underuse tax act that's being implemented, and it became effective as of January 1st, 2022. So a lot of us are exempted from being taxed, but for corporation-owned rental property, residential rental properties, as of right now, you still have reporting obligation, even though you don't have to pay the tax, but you still have an obligation to report on the filing. Now, the last one, that's why I said it's 10-ish, because the last one is a little bit trickier. It may apply to you, it may not apply to you. For those people who are considering donating money to charities, for those people who need subscription medical drugs, it may be the time for you to also consider getting all these, maximizing all these benefits. If you qualify, you would be able to claim the tax deduction in 2022. So that would also allow you to lower your 2022 tax payable. Now that we've gone through 10-ish year-end tax tips for everyday Canadians. If you have any questions, make sure that you leave a comment in the comment section below. If you like our video, make sure you give us a thumbs up. And if you like to stay on top of the latest tax tip, make sure you hit the subscribe button below. Until next time. Okay, picture.